Morning. Thank you all for coming to today's panel, Corporate Responsibility Maximizing Shareholder Benefits versus Social Justice. My name is Matthew Hyman. I am currently with George Mason University's National Security Institute, but recently I was a corporate secretary at a major public company, so I have a particular interest in this topic, and I'm delighted that we were able to put together a terrific panel to talk about it. Let me give very brief bios for each of our panelists, and then we'll get into the conversation. The first panelist, sitting directly to my left, Paul Atkins, is Chief Executive of Potomac Global Partners, LLC, a financial services consultancy where he leads client work for the financial services industry. Mr. Atkins regularly serves as an independent compliance consultant and a court-appointed monitor in settlements involving the Department of Justice, the Securities and Exchange Commission, the Commodity Future Trading Commission, and the Financial Industry Regulatory Authority. Prior to founding Potomac, Mr. Atkins, from July 2002 to August 2008, served as Commissioner for the U.S. Securities and Exchange Commission. Jonathan Macy, who is sitting on the opposite side of the dais from me, is the Sam Harris Professor of Corporate Law, Corporate Finance, and Securities Law at Yale University. He's also a professor in the Yale School of Management. From 1991 to 2004, Professor Macy was the J. Dupratt White Professor of Law and also the director of the John M. Olin Program in Law and Economics at Cornell Law School. He was also Professor of Law and Business at the Cornell University Johnson Graduate School of Business. Professor Macy is the author of several books, including the two-volume treatise Macy on Corporation Laws. He's also written Corporations, including Partnerships and Limited Liability Companies, and Banking Law and Regulation. And finally, sitting next to the podium is Andrew Schwartz. He joined the Colorado Law faculty in 2008 and was promoted to full professor in 2017. He teaches and publishes on corporate securities and contract law and is an internationally recognized expert on securities crowdfunding. In 2017, Professor Swartz served as a Fulbright Research Scholar and visiting professor at the University of Auckland Law School in New Zealand. Before entering academia, he practiced corporate law with Wachtell, Lipton, Rosen, and Katz. Just to frame this issue a bit, The Modern Corporation and Private Property was a book written by Adolph Burrell and Gardner Means in 1932, and it remains a highly cited work by management theorists. It espouses a stakeholder theory of corporate governance that argues the purpose of a corporation is broader than simply creating shareholder value. The stakeholder view of management held sway until the 1970s, when academics and policymakers began to push in a different direction. Perhaps most famously was Milton Friedman, who in 1970 argued that the only social responsibility of a business is to increase its profits. Today, the idea that corporate governance should take into account not only shareholders but also stakeholders is again in vogue. BlackRock CEO Larry Fink's April 2019 memorandum to CEOs stated that BlackRock would be taking into account corporate social responsibility in investment decisions because, quote, profits and purpose are inextricably linked. Which approach should company practice and legal policy take? Should we attempt to reconcile social justice and maximizing shareholder value, as Mr. Fink suggests? Each of our panelists will make brief opening statements. We'll then have some discussion amongst the panelists, and we'll reserve some time for audience Q&A. I'd like to begin with Mr. Atkins.
Yeah, okay. Well, thank you, Matthew. It's great to see you all this morning. Great to be here, and look forward to the rest of the conference as well. So with respect to our topic here about corporate social responsibility or corporate responsibility in general, and to whom do they owe a duty, I think you have to step way back to where corporations came about. And there's a book that I used that came out right after Sarbanes-Oxley was passed. This is about 2003 by two economists of the newspaper, The Economist, but two reporters called The Company. And it's a real little book. It's maybe 150 pages or so long. It gives a really good, quick overview of where corporations come from. They trace them all the way back to the Sumerians, all the way through Sarbanes-Oxley. But it's it's obviously a way for society to organize people to produce a product and to aggregate capital. And so I think throughout all of this debate, we have to remember, where does capital come from and why do we have all this and what is the good that comes out of companies. So if you go to fast forward to Adam Smith, from the Sumerians all the way to Adam Smith's time in 1776, he really didn't like the public limited company. He thought that basically that it was a product of monopolies, and he was looking at crown companies and those sorts of things. And so he was much more focused on the sole proprietorship or a partnership where there's not the agency problem between management and the owners of the company, and where there's a direct responsibility all told. But he didn't live in a time of plaintiffs' lawyers and that sort of thing. So limited liability was, which he viewed as a subsidy, which I guess one can argue that it is. But that really allowed a lot of aggregation of capital to do things like exploration, the East India Company, and those sorts of things that the British Empire pioneered. And then, of course, in the United States, we adopted that from the English legal system. So as far as to whom the corporation owes a responsibility, obviously the primary one should be to the shareholders who are risking everything. They're the ones at the end of the day who are holding the bag, and if the company fails, and they're the ones through the board of directors who appoint the management of the company and ultimately are accountable for everything. So I think that's how you have to read Milton Friedman's exposition there in 1970 to refocus on where does capital come from and why is that so important, because nothing is immutable. Corporations don't have really any certainty of survival. If you look at the Dow 30 today, for example, versus 80 years ago, back in 1939, there are only 3 companies that are left in the Dow 30 from back then, and 2 of them are oil companies. And if you go back to 1920, there are none left that were back there in 1920, and even just 40 years ago, there's 7 left. So you can see how this changes over time, and there's no guarantee that Microsoft will be the highest capitalized company because there's competition and new inventions and all of that. So in that regard, when we look at some of these proposals coming from Elizabeth Warren and others, I think you have to, focus on where does the capital come from. You can be like in Germany, for example, where they have what's called Mitbestimmung, which is where she's getting her idea of a certain percentage of the board that should be reserved for employees. That was imposed in Germany by the occupation, actually by the British, and maybe the Americans had some thing to do with that, but that was a way of trying to break up the big German conglomerates that at least the Allies thought helped lead to the 2 world wars. So in the United States, basically if you look at corporate law, it's focused by the states on the shareholders. And I have to say personally, if a company is making money and building good products, and obviously it has to do things legally, but if you have happy customers, you'll have happy shareholders because people will be buying the products. If you have happy employees, you're going to have happy shareholders because the employees will be working hard and being efficient and producing good products, and hopefully management is looking after that. If you have a happy community, you're going to have happy shareholders as well because, of course, a company has to work within the ambit and the environment of its community and be a good neighbor and produce good things. Does that mean that it has to build a baseball field or whatever? I mean, those are the things that are up to the board and then obviously up to the shareholders. But with respect to what is a stakeholder, the trouble with that is it's very ill-defined. And where do you put the boundaries around that? And you can, as you build it out, you get to people who have no real pecuniary interest in the success or failure of the company, and I think that will lead to bad public policy ultimately in the end. So anyway, with that, let me pass it on, that we can, I'm sure, have a discussion about it.
Thanks, Paul. Jonathan?
So, this topic has caused me to think a little, to recall a famous line by F. Scott Fitzgerald that people should have the goal of being able to hold in their mind simultaneously two contradictory ideas. And the two contradictory ideas I have are about the merits or how the wisdom of a panel on this topic, because I simultaneously think that on May 8, 2019, this topic is both silly, kind of uninteresting, but at the same time, I also think it's very important. These are obviously contradictory notions, and I want to just spend a couple of my 5 minutes explaining why I hold these two contradictory views. First, with respect to the idea that this is kind of silly, my argument is very simply as follows: markets work. So the professoriate, like myself, or the political class, like Elizabeth Warren, can pontificate all they want about the merits of expanding the traditional rule which gives fiduciary obligations exclusively to shareholders and expanding that to have broad notions of corporate social responsibility or social justice. The problem with that view, and the reason I think it's kind of silly and a waste of time, is that the people who are running corporations do not run their corporations on the basis of what Elizabeth Warren thinks or what some professor at some law school thinks. These people are subject to and critically constrained by market forces. So we see this in sharp relief with the emergence of activist hedge funds, the market for corporate control, the high-powered, performance-based incentive compensation. And people are saying, people who run corporations are saying, we can't think about the long run. We have to manage for the short term. People are so focused with laser-like intensity on quarterly results, and the reason that they are focused on quarterly results, the reason they're focused on beating analysts' expectations is because they're constrained by market forces. They're important market forces that force managers to maximize profits, not only in the managerial labor market, but in capital markets and in product market. So this topic may have some kind of philosophical interest or academic interest, but as a practical matter, I'm not very worried about the outcome of this debate because the reason I just said, I think markets work, and markets are going to serve as a very effective constraint on managerial or political efforts to cause corporate officers and directors to expand their duties beyond the traditional goal of maximizing the value of the firm and shareholder wealth maximization. Having said that, at the margins, at the edges, when you have a takeover contest, rules about corporate social responsibility may empower incumbent management to resist takeovers more enthusiastically or vigorously than they might otherwise be able to do so, but I think it's a very small, marginal benefit. So let me turn to the contradictory idea. Why does this matter? Well, I think the reason that I'm interested in this subject and pleased to be here is that this notion that corporate officers and directors should do anything other than maximize value for shareholders is, I think, part of a larger attack that we're seeing these days on the whole idea of the free market and the private contracting process. So we've seen, for example, it was something that's been of great interest to me during to this day, but really acutely during the Obama administration, was the strong pushback against private corporations, particularly in the fast food industry, that wanted to have covenants not to compete imposed as matters of contract with their employees, and people thought, well, this was a horrible idea. We also see payday loans. This is a private contracting process where the notion is that consenting adults, consenting individuals in the loan market are somehow not permitted to reach the results that they would want. And here too, the idea is in the corporate context, the social responsibility idea is simply, well, we have these contracts, whether they're labor contracts with employees or whether they are the contracts that corporations have with shareholders, which are much more loosely specified. And the outcome generated by market processes that say that the contracts with suppliers and employees and other corporate constituents that are not shareholders will be defined and delineated by specific terms of agreements, and that the residual claim holders to the earnings of the firm, which are the shareholders, will also have the right to profit maximization, which is really what the notion that officers and directors are supposed to maximize the value of the firm and owe fiduciary duties exclusively to shareholders is all about. That we have to upset that. And I've spent a lot of time in scholarship some years ago, kind of just trying to go through the sort of the contractual basis for this idea, just to make the point that shifting fiduciary duties away from shareholders and making them broader is not going to help any of the constituencies in the company, because the shareholders will have to give up, will lose value as a consequence of this occurring, and to the extent that these other constituencies are obtaining a benefit, then in a competitive equilibrium market, these other constituencies are going to have to give something up for this benefit that is worth more to them than what they're getting. So it's a kind of a classic basis for inefficiency. So, my view is that it's an interesting topic because it casts some light on, it provides some illumination about the particular moment that we are experiencing in history as being, I think, unusually hostile to the private contracting process and free markets. On the narrow issue of, is this a realistic threat to shareholder value? My answer is, well, as long as as long as these capital markets and product markets and managerial labor markets and markets for corporate control and activist investor, activist hedge fund markets are permitted to continue to function, then this debate is largely precatory, and it's something that doesn't really keep me up at night, other than it's a little bit of an annoyance. So thank you so much.
Thank you. Andrew?
Thank you very much. I'm really honored to be here on this esteemed panel and with all of you. So we are at an interesting moment here. In the 1970s, I think led by Ralph Nader and others, there was an idea to require companies, at least large ones, to obtain a federal charter, federal corporate charter, as opposed to the Delaware or other state that they usually have. And now we have a new proposal by Senator Warren and supported by many others to similarly require that very large companies, only very large companies, obtain a federal charter, and that this federal charter would impose stakeholder governance, meaning the board and the corporation is not designed purely to advance the interest of the shareholders, but for all stakeholders, all of those with an interest in the corporation, especially employees, but also the local community, the natural environment, maybe the nation, others as well, customers. So should we support this? Well, let me give you what I think are the strongest arguments in favor of the stakeholder model. There's really four of them that I want to present. One, stakeholder lock-in. Two, corporate political capture. Three, the diminishing marginal utility of money. And four, my personal favorite because it's based on an article that I wrote, the perpetual corporation. I'm going to explain all of these, but that's the roadmap. So first let's talk about lock-in. A foundational reason why shareholders under current law are given primacy is that they are locked in. Once they put their money in, it is irretrievably committed to the corporation. There's no threat of exit. I want my money back. So shareholders are in a vulnerable position subject to opportunism, which is what Burley and Means were writing about 100 years ago. So shareholders need fiduciary protection from the board, goes the theory, whereas other stakeholders, as Professor Macy mentioned, are voluntary participants by contract. They come to work, they buy the product, etc. They're not locked in. However, I don't think the premise is fully accurate, and others agree. There are many types of stakeholders who are, in fact, locked in, at least to some degree. For example, employees who develop firm-specific skills have locked themselves in to some extent. They can't easily switch to some other employer. They become an expert at, let's say, teaching corporate law. It would be very difficult to go become a computer programmer or something. Thus, they are vulnerable to opportunism in the same way, and perhaps they should be the beneficiary of fiduciary duties. Professor Macy makes a good point. Perhaps this would necessitate a pay cut, essentially, for employees. They might want it. I think Senator Warren would say employees would rather have a little bit lower pay and more certainty that they're going to continue in their job. Customers and even other types of stakeholders could also be locked in. Bank accounts are very difficult to switch. If you're on Venmo, it's very difficult to switch to another type. If you've spent years telling Netflix all your favorite movies, it would be costly to switch to another one. So to a less extent than shareholders, but to some extent, at least some customers are locked in as well and should maybe be given some protection. They're not really voluntary participants that could leave at any time. And maybe even the community. Think about Seattle with Amazon. Seattle is pretty well locked in to Amazon. You can't just switch out, oh, we want IBM now. And so perhaps the community also has a similar argument. We're locked in, we're vulnerable to opportunism. And maybe this is a charitable explanation to New York's decision recently to effectively send Amazon somewhere else. Perhaps New York appreciated that it would be locked in to some degree if they built certain infrastructure and did other things in this way. So argument number one, other stakeholders are locked in too, so maybe they deserve fiduciary protection. Second argument, And this is particularly important for the largest corporations. For years, and it goes back to Easterbrook and Fischel at least, the standard argument in favor of shareholder primacy, or one standard argument, is other interests can be covered through general law. If we're worried that a profit-maximizing corporation is going to pollute too much, well, let's just pass a law that says you're only allowed to pollute this much, or minimum wage laws, or any other law or regulation to protect other stakeholders. However, particularly in the era of Citizens United, where corporations are free to lobby as much as they want and spend the entire corporate treasury on advocating for laws and regulations or against them, I think that there's reason to question whether we should place so much reliance on the political process to adequately protect other stakeholders when corporations driven by shareholder primacy to advance shareholder primacy will lobby and affect the very laws that we are depending on. Argument number 3, the diminishing marginal value of money. It's sort of a long title for a simple concept that the same amount of money is worth different things to different people. If you have $60,000 in the bank, $100 is not that big a deal to you. If you have $600 in the bank, $100 is a tremendous deal to you. William Henry Vanderbilt has apparently once said, "I wouldn't cross the street for another $1 million." Well, I would. The idea is that people with greater wealth would place less value on an additional dollar, whereas people with lower wealth would place more. It is true that, let's just compare employees and shareholders. Many Americans hold shares, maybe a majority of Americans. However, the wealthiest hold more shares. So your typical shareholder, I think we can say, is wealthier than your typical employee. Thus, a corporation with $100 to distribute could distribute it to shareholders through buybacks or dividends or some other manner. But if that $100 were instead directed to the employees, Senator Warren would say, and she makes a good point, that would do more to raise social welfare. There'd be a greater good in the world from distributing that $100 to the employees rather than the shareholders. I think that Paul and maybe John as well would place a challenge here and say there's not going to be $100 if we have a stakeholder regime because employees and other stakeholders have different incentives. There's only going to be $20. And regardless of the diminishing marginal utility of money, it's better to have $100 than $20. Senator Warren, I think, would come back and say, okay, we won't have $100, but we'll have 90. I don't know who's right, but this is an empirical question that I think a lot depends on in this debate. If moving to a stakeholder theory would mean the corporation would have 90 instead of 100, that's probably a net gain for the world. If it's 20, that's probably a net loss. Final point on the diminishing marginal utility of money, and I don't think this is where Senator Warren would want this discussion to go. Let's compare factory workers in Akron, Ohio, versus factory workers in Phnom Penh, Cambodia. I think the factory workers in the latter would place even a higher value on the $100. So if we take the view that all people are of human worth, we could increase social welfare even more by doing something like closing a factory in Akron and moving to Cambodia, just to keep that in mind. Finally, and I'm going to just wrap up in just a moment here, the final argument, I think, in favor of stakeholder theory, at least, is it's sort of oblique. The modern case law, at least in Delaware, views shareholder primacy as the goal, but it takes the view that it's a long-term question. And as I said, I've written an article that I call it the perpetual corporation, where I make the argument, and this was accepted in at least a few Delaware cases, I make the argument that the perpetual nature of the corporate form drives the legal obligation to manage for the very long term. And I think, as Paul mentioned, stakeholder theory and long-term shareholder benefit often come very close together. You can give your employees college tuition, pay your bondholders on time. If you're a logging corporation, manage the forest responsibly, replant and things like that. These are all the sorts of things that stakeholder theorists and social justice proponents would support. And so in many cases, although not all, in many cases, these two ideas, I think as John was maybe suggesting, are not really in tension, but really do come together, at least in the long term. So those are my, I think, strongest arguments in favor of stakeholder theory, and I look forward to the discussion.
Thanks, Andrew. Paul, do you want to react to anything that was said by either John or Andrew?
Oh, yeah, the arguments for, a federal charter and whatnot and going down that road with respect to stakeholders, been made, and it's been, like Andrew's saying, and this has been bubbling around for years and years and years, a century or more. And, where we are right now is, I think there is some kind of disingenuousness on the politicians who are proposing this, because we've just seen over time here a growing politicization with respect to how corporations are viewed and how the political class is reacting to them, and especially other particular stakeholders, unions and other types of folks, where they are focusing on the ends that they're trying to get at with respect to, in the union's case, their organizational goals and whatnot. But we've seen it through, the Sarbanes-Oxley Act and Dodd-Frank, and a number of ways where there have been provisions in there to try to turn corporate efforts and corporate actions towards a political goal. And it's just basically the question is how to harness a private action where if you can't get it necessarily through the legislature or through the executive, how do you harness private action into achieving some of these goals? And so if you look at Elizabeth Warren's bill, when they talk about companies, it's not necessarily just companies that we normally think of, but if you kind of take it to an extreme, it could affect private equity firms, for example, even private companies who reach $1 billion in assets or revenues or whatever. So regardless, they would be forced then to become a public federally chartered company. And so that really then starts to focus us on what then would happen with people who are interested in putting their money at risk and investing in a corporation. And if you look now at the private companies or the public companies that we have in the United States, right now we have fewer than half of the number that we had 20 years ago. And so we have a lot of the unicorns, and some of them now are sticking their toe in the water about going public, Uber, Lyft, and some others, but there's still lots on the sidelines who just view it as not being worth the effort and the time and the money to go public. And there are lots of stories about companies that have gone private and the amount of money and the less headache and heartache that they have with dealing with the public markets as they've gone private, the amount of money they save versus registering with the SEC and all that sort of thing. So I think ultimately, again, companies come about to try to produce products that people voluntarily buy. And so customers who are quote unquote locked in, just like we were maybe 150 years ago locked into using kerosene or whale blubber to power our lights, that kind of went the way of the horse and buggy, of course, and whatnot. And now maybe the same with oil, and who knows what's going to happen in 80 years' time in the year 2100. Like there have been some reports that shareholders have rung out of companies to talk about, what might happen if, in 2100, if the average temperature increases by 2 degrees centigrade. So those sorts of reports that have come out from companies actually paint not such a bad picture for example, as far as corporate survivability goes, but you never know. And those stats that I talked about with the Dow 30 kind of really emphasize the point that nothing is forever.
John?
So one area, I think it's always a good idea to try to bring into sharp focus areas of disagreement among the panelists. And I think one potential area of disagreement between myself and both Paul and Andrew is on the kind of empirical question, descriptive question of does it matter? I may be mistaken, but clearly in Andrew, and I think a little bit in Paul's different perspectives on corporate social responsibility, is a shared view that it matters, right? And I think I can actually demonstrate that it doesn't matter. So let me try it in this way. Imagine, what we're talking about, of course, is the idea of the notion that we should have a legal regime in which when corporate decisions are being made, instead of a legal regime that dictates maximization of shareholder value, we have a legal regime that says that all of the interests of all constituents, including local communities, workers, suppliers, customers, as well as shareholders, should be considered. Okay, so there are only two possible states of the world with respect to this issue of should the legal regime be changed. One state of the world is, that the current shareholder wealth maximization paradigm that we observe in Delaware is ineffectual, doesn't constrain management because management can effectively justify anything that it does almost anything within reason as furthering or being consistent with the long-run interest of the firm, and the shareholders. So we give money to charity. Well, it helps the company's reputation, so that's okay. We give workers job security. That's okay because under the business judgment rules, it's consistent with shareholder wealth maximization because the workers are more loyal and will make bigger investments in firm-specific human capital, and et cetera. So even a kind of third-rate economist or judge or lawyer can pretty much justify, and has, if you look at the cases, whatever management wants to do on the grounds that some constituency benefits. So that's one possible state of the world, and as I suggested in my opening comments, I am just as a descriptive matter, I think that's the world we live in, pretty much. Having said that, let's say I'm wrong, okay? So Macy's wrong. Let's say that that there is somehow in the shareholder wealth maximization legal paradigm, this operates as some kind of constraint on management. So the question that I have is, the obvious question, I think, right, is, well, what would happen if we relax that constraint such that now managers don't have to maximize value for shareholders, and they can maximize value for these non-shareholder constituencies? What is truly, I'll use a term of art here, kind of wacko about this shareholder social welfare paradigm is that, of course, inherent in this notion of maximizing social justice or accomplishing goals for non-shareholder constituencies, implicit in this conception is the idea that we're giving management unconstrained discretion to decide this question of what is social justice. We have the idea of we're going to move the plant from New Haven, Connecticut to South Carolina. Well, if management can say, I want to do it, it maximizes value for shareholders, and that's a legitimate corporate end. Or management could say, well, we're not going to do this because it would be bad for workers. In other words, I think if one observes honestly this notion that we should expand the scope of fiduciary duties to include non-shareholder constituencies. What this is a maneuver to increase the unconstrained power of incumbent management under a thin guise of a sort of politically correct, well, we want to help all these non-shareholder constituencies. But I don't think that there's any evidence or any theory to suggest that should management be given this additional power, these additional degrees of freedom associated with embracing a broader conception of the duties of managers to expand beyond shareholder wealth maximization, that they're actually going to do this in any way other than the way that maximizes benefits for management, as distinct from these other constituencies. So it is a strange conception. The idea is, well, we want to make the world better for these non-shareholder constituencies, so we're going to increase power and discretion for management. Is a strange idea, but quite amusing and entertaining, so I'm glad we're able to talk about it this morning. Thank you.
So, Andrew, any thoughts on the idea that giving management a social justice license to hunt, so to speak, creates philosopher kings that endanger society?
Well, that's a fair question. I think I would say to respond first, I guess to John's point here, that a manager, it's called the too many masters argument. A manager told to serve multiple masters, a little for the consumers, a little for the environment, will be freed of all accountability and can justify any decision, including self-interested ones, on some basis or another. Agency costs will run wild. This is a well-known concern in the literature. To quote Professor Macy, but the too many masters argument is overstated. It's a direct quote from my colleague here. And I think he's making a good point that people routinely take into account many different interests and are able to make rational decisions. And in the long term, managers must, as we've discussed, actually consider all the stakeholders, even if they're just trying to achieve shareholder benefit. And then, Professor Macy makes this point in a 1991 article. He says that managers have for some time been able to balance the conflicting interests of different classes of shareholders, preferred shareholders, other classes, and this hasn't led to unbearably self-interested behavior. So I think that is true and it is possible. But just to go back to the other point of John's two prongs. So issue 2 was this would just leave managers with unconstrained discretion to benefit themselves. I think it's a theoretical concern, but especially for the largest companies that we're talking about, the intense publicity over such decisions might act as another constraint. And then just finally, back to John's first point, suggesting, and this is widely suggested in the literature, that the business judgment rule is so capacious that it gives managers such discretion that as a practical matter, they can, in fact, benefit other stakeholders even at the cost of shareholders. And so switching to a stakeholder regime would not actually change anything. Let me at least clearly refute that view. I think it's quite clear in the recent cases, cases like Trados and a case called Sue, HSU. The Delaware court held that the board was wrong to consider the interest of a certain stakeholder over shareholders. In those cases, it was about preferred shareholders with a liquidation preference. But this is purely a result from our current shareholder primacy regime, and it would change. I think that if Delaware or if this Trados Corporation were allowed to consider other constituencies, those cases would come out the other way. One final point that I want to just raise, though, is it's been discussed that market forces will effectively lead back to shareholder primacy, regardless of what we do. I don't know if, or that might be true at, let's say, your normal corporation where all shareholders get one vote. But there's a lot of major corporations, especially in recent years, going public with dual-class shares or even no-vote shares, meaning like Snap, for example. Snapchat's maker, Snap, went public and sold the public non-voting shares. The only voting shares, I think, are in the manager's control. So those managers, I think, are free, would be free to act as philosopher kings without the market force, without the market control of shareholders voting them out because they don't have the vote. Facebook, with its low vote stock, and Google are other examples.
Just quickly to respond, two quick points. One, my objection to having a legal regime that has responsibility not just to shareholders but to all of these different corporate constituencies is not predicated on, my objection is not predicated on a concern about too many masters. Quite the opposite. My concern is predicated on the idea that managers will have no masters. So this quote from decades ago, it is, I think, we observe managers subject to contract are able to fulfill their contractual obligations to workers and to suppliers and producers under the current regime. And but I think that as I said a few minutes ago, I think the problem is kind of a no masters program. Finally, with respect to this idea that this would matter because of the idea that the court has said has reached results in which their holding is that they admonish corporate directors and managers that they have to maximize value for shareholders. I have 2 points to make. The first point is all that these cases do is to change the way that management and boards of directors articulate the motivation for whatever decision they make. And instead of saying, well, we're deciding to benefit preferred shareholders over common shareholders, management can simply say, we are making this decision because it benefits the long-term best interests of the corporation. It gives us better access to capital or whatever reason they want to come up with. So it's these decisions are not, in my view, outcome determinative. They're simply changing the rhetorical process, number one. Second point I wanted to make is simply to say, I've never seen an opinion, I don't think there are any in existence, in which management has said, I want to do something that benefits workers, and the court has said, oh, well, you can't do that. You got to maximize benefits for shareholders. Similarly, I've never seen a case in which, at least not in the last 100 years, in which the court has said, oh, you want to give money to, Princeton University or some a charity. Well, can't do that because you have to maximize value for shareholders. There's enough discretion to say, well, charitable giving is good because it helps the reputation of the company, and we're not going to get into the sort of micromanagement as judges, micromanagement business of saying which charities are more likely to help the bottom line for shareholders. So we'll give kind of unfettered discretion. So I think that as I said before, I think managers have huge amounts of discretion now. But even if they don't, and these current rules do constrain management and cause them to work to maximize shareholder value to a greater extent than they would if we had a regime that allowed management to pursue the interest of any constituencies they chose, I think that's so much the better.
One of the questions I wanted to put to the panel is around the issue of metrics. Corporations, particularly publicly traded ones, are intensely focused on metrics, as they need be, particularly when it comes to quarterly reporting, whether it's revenue, whether it's profitability, earnings per share. And those are very finite metrics by which you can measure the efficacy of that management team in a shareholder-centric model. One of the criticisms of adding sort of social justice to the mix of obligations of management is there are no clearly defined metrics around how do you measure how much social justice an organization is creating. I was just wondering if the panel had any thoughts on whether that criticism was a fair one. Can you actually measure how much social justice is being generated by an organization? But I mean, I know that's a stumbling block for the advocates of sort of a more socially aware or socially engaged corporate organization. I don't know who wants to take that.
Well, I can take a stab at it because I think it's a good question because I do think it's very a squishy topic because we see it even in sustainability now where there are all sorts of folks who are, if I got $1 for every time I heard sustainability, I would be very wealthy. But it's something that nobody can really identify or define. And the same with environmental, social, and governance sorts of shareholder proposals that are being put up to various corporations, as far as a lot of the proposals that have come up are all very kind of vague, except in the governance part where they tend to be a little bit more defined as far as the way the corporation should be governed. So I think that's a great point. But one thing I wanted to, just in that context, I have a quote that I wanted to read from it's an old movie, Sabrina, and so Humphrey Bogart and William Holden are in it. And but anyway, so Humphrey Bogart, you have to imagine his voice here with his New York accent.
Are you going to do it for us?
Yeah, but so here you have a normal corporation, obviously not one that it's a private corporation probably. But anyway, he launches into this soliloquy, which is pretty good. He says, "A new product has been found, something of use to the world, so new industry moves into an undeveloped area. Factories go up, machines are brought in, a harbor is dug, and you're in business. It's purely coincidental, of course, that people who never saw a dime before suddenly have $1, and barefooted kids wear shoes and have their teeth fixed and their faces washed. What's wrong with the kind of urge that gives people libraries, hospitals, baseball diamonds, and movies on a Saturday night?" So that's all through private enterprise, not through any kind of, now how one would value that kind of social justice type of thing, or the benefits to a community and to the workers and whatnot. That's all from something that is not wrought by any kind of fixed construct through corporate governance.
Andrew, any thought on the metrics issue?
Just briefly, I would say that there do exist various reporting systems for ESG, environmental, social, and governance.
They're all very vague.
I believe they are vague, but then I'll also say there are funds, I believe, mutual funds, maybe hedge funds as well, that have investing strategies based on these factors. So I would think that those folks with money on the line, we could look to them for some sort of reporting systems.
Yeah, they're also all over the lot, and no one does it the same way, and everybody views it differently. And they have then different rates of return and all of that. It's not really any kind of, it's not a science, let's say that.
Agreed.
Just, I think we're about 15 minutes ago. I'm happy to open it for questions from the audience. Yes, sir, right here on the aisle.
Hi, thank you. Being in a corporation myself, I see this movement towards the pillar of what we look at is how we affect all these various stakeholders. And as Paul and John's comment, which I agree with, is those constituencies you have to take into account. We're very quickly, information things quickly. When you take them into account, you're maximizing shareholder value. If you don't take them into account, if you don't treat your employees well, if you don't take care of your community, if you don't, when you want a permit to do what the community wants, then you're not going to get into business in new markets. You're not going to do well. So my sense is that whether it came from the BlackRock CEO's comment or just the movement of the markets generally, this is happening, especially for the biggest companies on the horizon. My concern with the topic, beyond its interest, is this is the legal aspect of it. It's a shot across the bow. You look at the millennials, how many people voting, where you're voting. This is the next piece towards that triangle definition of socialism. My view is you have to be very much against this. You have to emphasize the points you're making. We go further into the quagmire. If you give them this much, then they want more. Who's going to control the company?
So does anyone want to comment on what I think is it's the slippery slope argument, or the camel's nose under the edge of the tent?
During the Cold War, I remember East Germany, East Berlin, West Berlin.
Yeah. I agree with you. Yeah. I mean, I guess the only thing I would say is, if one looks at this sort of the nature of this debate, which is, Paul rightly observed, has been going on for a very long time. Initially, it was, the proponents of this view were kind of expanding duties, were not nearly as hostile to markets as they are now. So I think you're right that this sort of recent resurrection of this decades-old debate, particularly from people like, particularly from Elizabeth Warren with her federal incorporation proposal, is a major shift. And so it's one thing to say, as a precatory way, take into account all the interests of these non-shareholder constituencies. It's quite another thing to say, well, on your board of directors, you must have 50% representation by unions and representation by suppliers, et cetera. And then when you move, then that in my view is the sort of shift that the nature of the debate takes from a sort of amusing academic thing to, as you point out, really something that could destroy a lot of wealth and value and progress.
We have enough federal regulations, state regulations. Now we have internal corporate regulations we have to deal with to define every decision. You think we talk about France and places like that, where once you're above a certain size of an entity, then you can't make a change unless you go through certain things. None of us like to lose a job. The goal is that people won't lose jobs, so we don't create a society. We can't turn the ship. This is basically deer in the headlights of what we're creating here.
Right. Does anyone else want to comment?
Yeah, well, I think, I agree with you. I think it is, the prospect of, especially with how millennials are voting, although I still have hope that as they grow up and they start paying taxes and whatnot, that they'll change their outlook. And yeah, so they're right, exactly, even with my kids, right? So, and to John's point, I mean, when he says, well, is there really, difference here or not? Maybe not, but maybe so. I mean, who knows? Like, for example, if you look, because a lot of what's also animating Elizabeth and some of the other people who are pushing these sorts of ideas is that maybe there'll be a better kind of governance on the corporation. You wouldn't have some of the bad things that happen if you have much more of a diverse board representing different interests. But if you look at Volkswagen, for example, and how the problems that they have, because their supervisory board has lots of employees on it, including their unions. They're owned by the state of Lower Saxony, to whatever percent that is, 20 or more percent. And still they had, their problems with the diesel. Now, would they, the city of Wolfsburg or, Lower Saxony, would they, they have approved and gone along with the corporate strategy of building factories outside of Germany and elsewhere, and so that has all gone along. And would that be much different than if it didn't have any of those sorts of things? Maybe, maybe not. But how many textile factories in New England and elsewhere moved off to countries overseas, and would union presence on the board have stopped that? But then fast forward and think, well, what would have happened to some of those companies had they not built factories overseas? They would have been priced out of the market, not being able to sell their goods. And then maybe we would erect tariffs even more and barriers, and what would the overall effect on our economy, on the world's economy be? To some of your points, Andrew, like with employees abroad being people like here in this Puerto Rico example from Sabrina, being able to have their teeth fixed and all that.
Just briefly, I would just say, speaking on behalf of shareholder primacy, I would say I would recommend emphasizing the perpetual nature of these corporate forms and the obligation to plan for the very long term, to suggest to maybe a skeptical youngster that these are the best sorts of organizations, the ones that are going to be around tomorrow and the next day and forever. They're not fly-by-night, one round, let me cheat you and run away. If you're always going to be there tomorrow and the next day, and that's the nature of a perpetual corporation, your incentive is to behave well and treat others well for future rounds.
Next question. Yeah, the gentleman right here in the second row. Yeah.
Okay, I have really two comments, if I may. Really comments more than questions.
We're looking for questions. Do you have a question?
Okay, I'll do the question. Well, here's first to Mr. Macy here. I'm going to echo this gentleman's statement too. And when you talk about the when you say that as long as markets are working, you don't have a concern about all the other discussions about social justice, et cetera, that it's really more noise. That's how I take it. Doesn't that ignore the slippery slope? And as the gentleman says, all of a sudden you've got people voting, millennials who are accepting socialism, and before you know it, you're going to find that markets aren't going to work because we haven't stood up to that.
Yeah.
Let me just repeat the question because we're streaming and I just want to make sure viewers can hear it. And the question was along the lines of if you don't worry about sort of the incrementalism out there, do we eventually sort of create a stagnant marketplace where innovation and things fail to happen? Is that a fair characterization? In other words, yeah. Professor Macy?
Yeah, so I'm trying to find this. I agree with you. There was I think a great. We are living in a time of unprecedented attacks on capitalism. I was looking on my phone for Amherst College developed a definition of capitalism, which they circulated recently, that defined capitalism as a system that leads to great inequality, an economic system of free exchange that leads inevitably to great inequality. My point was not that these other interests should necessarily be ignored. My point was simply that if we allow the markets to work in an unconstrained way, in my view, from any perspective that one takes, whether one is looking purely at a kind of utilitarian wealth maximization, or whether one is looking at ways of kind of a Rawlsian view of bringing up the very bottom of the economy, that we're better off, significantly better off, with a free market capitalist approach. I agree with you entirely that it is a bad idea to frame the argument, and I don't believe it, that oh, I want to have shareholder primacy because I don't care about these other constituencies. That I think is the sort of kind of a ruse that is used, that I think is very unfortunately. Unfortunate. I think if one truly cares about accountability and results, regardless of this, I think has been Paul's point all morning, then the shareholder wealth maximization, firm maximization model is the way to go. But I think I agree with you. We kind of have to be sensitive to this, particularly in this day and age.
Yeah, well, sorry, just one quick thing to chime in, because I think when Andrew talks about the perpetual corporation, I guess I need to read your article about that.
I'll send it right over.
Okay, good. But so in my mind, just a perpetual corporation, you have to get back again to the shareholders and who's going to provide the capital. And even the term perpetual corporation, I would really argue with, because I don't think there's such a thing that you can have an enduring product, something that is demanded by customers because they like it. If I think back on what I used to type my high school and college papers on a Smith Corona typewriter, I don't think one can buy that anymore, maybe on eBay, or my Texas Instrument calculator from back, or in 7th grade when we worked on a Lang computer. None of those are around anymore, but a Louis Vuitton handbag still is, or whatever kind of things that are a product where it still retains some cachet where people want to buy it. And that's what I think is the enduring part of a corporation. And how do you ensure that that continues to be manufactured and then meet the demands? But if you don't meet the demands of the shareholders who are putting at risk their assets to try to help manufacture those products or services that people want, then you've really lost everything.
Yeah, the lady in the back there.
I wanted to mention that it strikes me as, to a great extent, that there's a dichotomy that is between stakeholder and shareholder, as if they're mutually exclusive, which they're not. But my question was that to the extent that private enterprise has verifiable, quantifiable social impact, is it now a matter of the degree to which altruism has left the picture? I mean, let's say in previous decades, business always had an aspect of concern for having a positive social impact beyond that, say, maximizing profit. Is it now the degree of the extent to which the scale has taken too far and we need to calibrate? I mean, are we talking about the means here, or is it just a matter of reinventing a whole chapter?
So to just repeat the question again for our webcast audience, is it a matter, is the stakeholder model and the shareholder model mutually exclusive? And have these not always been somewhat intertwined? And are we now at a stage where maybe we need to recalibrate or rethink about what that balance is between stakeholder and shareholder, since there are some metrics out there that seem to measure social good? Is that a fair characterization? Any of the panelists want to try and, Andrew, do you want to try and tackle that?
One thing I would
Or John.
really want to add to this is just your concept of altruism. So my concept of altruism is when someone sacrifices something personally for someone else's benefit. Where we're talking about public companies and managerial decision-making, what is going on in that context is that managers are deciding with shareholders' money what kind of social ends to pursue. And to my way of thinking, when corporations are engaging in ostensibly in activities ostensibly to further broad goals of social justice, this is not an example of altruism on the part of the managers, officers, and directors who are making these decisions. It's there because the currency with which they're paying for these initiatives is not their own. It does so. You know, I'm all in favor. I think altruism is an extremely important part of any social system, and in order to be successful, I think altruism needs to be encouraged. But I think we need to be. I think I want to be kind of disciplined about what activities I characterize as altruistic and which ones are simply people pursuing their own particular views.
Let me just say, I agree with John that you have to always be vigilant that people might say or even might sincerely believe that they're doing something for an altruistic reason when it turns out to benefit them in some way. But that said, let me just push back a little bit. John said it's the shareholders' money. The managers are giving away or doing what they want with the shareholders' money. I want to push back on that a little bit and say it's the corporation's money, and the money, the surplus here was created through a joint process of employees working hard and suppliers contributing and the local community, creating a nice environment to attract the company. So when there is some money and the managers have to decide what to do with it, I can't say that it's fully accurate to say that's the shareholders' money.
Yeah, well, so one quick thing too. So, I mean, as far as altruism goes, I think John's trying to say this, that it depends on through what lens and what perspective you're looking at as to what's altruistic. That snippet that I read from that movie Sabrina, I mean, shows, I mean, I think that's altruism, where by, purely, this is the invisible hand of Adam Smith, that through that invisible hand of building that factory and providing work for people so that they have money to spend because there's a demand for the products that they're building, really creates wealth, more so than, some kind of, it's not just the shareholders' money that then gets divided up, but it's being put to use to build something greater for everybody. And like Andrew's saying, employees are a part of that as well. But in the end, there's a market for everything, and there's a market for capital coming into a company, and shareholders are looking for a particular return based on the risk that they perceive investing money into that corporation. If that return isn't there, they're going to go somewhere else. And hedge funds are finding this out right now because there are so many of them that are closing up because their fees are too high, they don't have the returns. People can get it right now at the S&P 500 through an ETF. So they are fleeing hedge funds. They're all shutting down, and only 10 years ago, they were riding high and everybody's darling, right? So shareholders vote with their feet, and and so companies have to react and have to constantly be vigilant to provide that return, because they'll be out of business if they don't.
Just to respond to this point that when I said it was the shareholders' money, the reason that it's the shareholders' money is because this is a matter of basic finance and contracting. The shareholders are the residual claimants to the cash flows of the firm. These other constituencies, such as employees, producers, suppliers, are fixed claimants, so that when the company gives $10 million to Princeton or buys subscriptions to the Met for the Metropolitan Opera for the CEO, this is money that otherwise would go to the shareholders. It's not money that otherwise would go to bondholders or employees, because these other non-shareholder constituents are fixed claimants whose claims are determined by contract, and when the company does better, these other, that it doesn't immediately inure to the benefit of these other groups.
So I think on that note, unfortunately, we have just run a minute beyond our time. I want to thank the audience, thank our viewers on the webcast, and please join me in thanking the panel.
That was fun. Good to meet you.
No.